Welcome back, students who are taking financial accounting, and in this series of videos we are working on the assigned homework problems from the digital study guide for chapter 7, the problems from group B. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. So for this video, we were working on problem 7-54, and it's accounting for notes receivable. It says here, record the following transactions in the journal of Soothing Sounds Music. Explanations are not required. Use a 360-day year for interest computations and round to the nearest dollar. Okay, so make sure you pause the video when you need to because I am going to be racing along the way. I'll be working just on this slide here. All right, so yeah, pause the video and write down whatever it is that you need to be, because I'm just going to erase when necessary. All right, so December 6th, received a $6,000 90-day 8% note on account from LM Publishing. All right, so in other words, we're the ones issuing the note. Okay, so of course that means we're the ones that are going to we received the note on account. Let's see here. Let me think through this. Received the $6,000 90-day 8% note on account. All right, so yeah, all right, so we're going to debit our notes receivable for $6,000, and we are going to credit our accounts receivable for $6,000. Okay, the reason why is, as I thought through this for a second, originally, see, notes receivable generally come in two fashions. The first could be, a business is just going to lend. All right, I'm going to use the same $6,000, okay, for 90 days as my example. But in the first instance, for the creation of a note receivable, LM Publishing could have just come to us and said, hey, look at, maybe we're good friends with the owner or whatever have you, and he says, hey, can I borrow $6,000? I only need it for 90 days. Okay, so we can create a notes receivable in that manner, and when we give them the $6,000, we would debit the notes receivable for $6,000, and we would credit cash for $6,000. Okay, because we're just giving him the $6,000. Right, but here in this instance, which is the second way notes receivable are generally created, right? It says receive the note on account. Okay, so that's why I had to pause and think about this, because I was like, okay, I'm running through my mind, because it's more often a business is going to just create a note receivable by giving the person cash. Generally, it doesn't happen. I mean, it can happen, but it doesn't happen that often where you convert your accounts receivable to a note receivable. All right. Usually, if your note receivable, meaning it's already 30 days old or possibly longer, okay, it stays on the books as an accounts receivable and ends up going into bad debt. if first, if someone is coming to you and saying, hey, I need some extra time to pay, whatever have you, you'll end up, and this is what happens in the real world. You end up saying, okay, we'll keep the accounts receivable, but we're going to have to charge interest, right? Well, that accounts receivable, every month, can accrue interest as an interest revenue. And let's say that $6,000 is, say, 10% interest. So that's like $600 a month, right? I'm just making something up here. So each month now as accounts receivable, you'll bill him, all right, for the 6,000 plus the additional 600. And when he pays it off, you'll just wipe out your accounts receivable. You don't generally turn that accounts receivable into a note receivable. Now, can it happen? Yes, it can happen. And that's what we're doing here for 12-6, is we're saying that, okay, this was on account. So we're converting our accounts receivable to a note receivable. So if we had debited our accounts receivable to begin with, because we credited our revenue, right? That was the original sale for 6,000, all right? Now when we convert the accounts receivable, because this is on account, into a note, well, we have to take our accounts receivable, off of it. We have to get rid of our accounts receivable, and that's why we're crediting the accounts receivable, and we're moving it to the note receivable, all right? So, that's my thinking behind that, all right? Like I said, in this textbook, they do some strange stuff that isn't, that doesn't happen in reality that often, but, just be aware that it is possible to do that, to convert your accounts receivable to a note receivable. All right, so that's that one. All right, 1231, made an adjusting entry to accrued interest on the LM publishing note. So 1231, we're going to accrue our interest, because notice that this is December 6th. At the end of the month, we're going to accrue the interest. So let's calculate the interest. That's 6,000 times 8%, or 0.08, times how many days? Let's see, this is 31 days, so that's 25 days over 360. Do the math. Is 6,000 times 0.08 times 25 gives me 12,000 over 360. We're using the 360 because it says use 360 per year and round to the nearest dollar. So this actually ends up being 33.33 as a repeating decimal. So it's 33 bucks. Okay, I'm erasing this. So we're accruing our interest, so that means we're going to credit our interest revenue for $33, and we're going to, since it's owed to us, we're going to treat it as an interest receivable for $33. And again, just be aware, go back and watch the theory videos and my discussion on creating an interest receivable account. I would, as to where that would be. I mean, for the purposes of the text, we're going to use interest receivable, but in reality, we would probably create an accounts receivable account called interest receivable LM publishing, all right? And so I'd actually make it a debit to accounts receivable instead of a debit to interest receivable. But both ways are technically correct, all right? All right, December 31st, made a closing entry for interest revenue. Okay, so this closing entry for interest revenue, all right, would just be part of the normal closing process. Interest revenue is a revenue account. We close out when we're doing our closing process. This is going back to chapter 3, right? When you make your closing entries, we would just close out all of our revenue and our expense accounts. Well, interest revenue would happen to be one of them. But in this case here, we're going to debit interest revenue for 33, and that's going to get moved to retained earnings 33. Also be aware that for this here, closing it out to retained earnings, all right. If you watch my theory videos on the introduction to accounting and bookkeeping, or even the chapter 3 theory videos, you'll see that we don't, in the real world, you generally do not make an entry directly from the revenue to the retained earnings account. You move your revenues and expenses to your income summary account first. And another name for income summary is your revenue and expense accounts. And then you move it from the income summary to retained earnings. Okay. Just so you're aware of that. So that's a deviation from the solution in and of itself. But, I'm not going to go and repeat all of that. Go back and watch those videos. Just be aware that, even though this entry is technically correct, generally that's not how it's done either. Okay, let's see here. Now, 2014, on March 5th, collected the maturity value of the LM publishing note. All right, so on 3/5, we're going to collect the maturity value. Okay, so first we have to determine, we know that $6,000 is the note itself, right? We know that we have an interest receivable of $33, right? And we have to calculate the remaining interest revenue. So to calculate the remaining interest revenue, we have 6,000 times 0.08 times, if it's 90 days, and to calculate this interest revenue, which we did right here, okay, that was 25 days, so 25 from 90 is 65, right? So we have 65 days left of interest revenue that we're calculating. So that's 65 over 360. And if we do the math, 6,000 times 0.08 times 65 is 31,200 over 360, which is equal to, so we divide 3 by 360 and we get 88.66 is a repeating decimal. I'm sorry, 86. So we're going to round that to $87. Okay, so the interest revenue is going to be $87. Okay, that means that our total interest is 33 and 87. That's 10, 11, 12, 120 plus the 6,000. So we're going to receive cash for 6,120. So we're going to debit our cash for 6,120. And now we have to credit everything. So we're going to credit our notes receivable to offset the notes receivable. So that's for 6,000, reducing it to 0. We're going to credit our interest receivable account here, right, in order to offset that for $33 to reduce that to 0. And then we have to book the interest revenue that had been earned. So we're going to credit interest revenue for $87. Okay, so that's our March 5th journal entry. Okay, so now it says, loaned 12,000 cash to Sound Systems, receiving a 6-month 7% note. Okay, so this basically is, as I started this video, I had said, okay, there's basically two ways of creating a note receivable, and I had talked about just loaning the cash first, and then actually creating a notes receivable second. So here we're doing the first one. So on 6/1, we're going to debit notes receivable for the 12,500, and we're going to credit our cash for 12,500. On October 31st, received a $4,060 60-day 6% note from Union Music on its past due accounts receivable. Okay, so again, all right, let me back up here. One, you create a notes receivable if you directly lend cash. Okay. Two, you can create a notes receivable if you're converting your accounts receivable to a note receivable. All right, so cash to a note receivable. All right, so for December 6th, this was receiving a notes receivable from the accounts receivable. So on March 6th, that was lending cash. I'm sorry, on June 1st, sorry. On June 1st, that's doing one, receiving cash. Now on October 31st, again, we're converting the accounts receivable. So 10/31, we're going to debit notes receivable for 4,000, and we're going to credit our accounts receivable for 4,000. All right, and then December 31st, collected the maturity value of the London Sounds note. So on 12/1, now the London Sounds note, right here, which is this transaction, okay? I'm going to do the math up here. We have to calculate the interest that was earned. So we have 12,500 times, it's a 7% note, 0.07, and it's 6 months, so it's 6/12, or 1/2, right? 6/12 is the same as 1/2. Mentally, I would have done the 1/2 because I just mentally converted 6/12 to 1/2. Just as a shortcut, because now I don't have to be messing around so much with such larger numbers, but I'll do it both ways. So I have 12,500 times 0.07 times 6 is 5250. Divide that by 12, which gives me 2625. Okay, so I'm going to I'm going to credit my interest revenue for 2625. Now, like I said, I mentally, it's 6 months, and so as I was writing this, mentally what I do is, okay, it's 6/12, because I think when I'm working, and I don't just do things blindly, I would have actually converted the 6/12 to 1/2. So then I'm only doing the math of 12,500 times 0.07, which would have given me 875, and in my mind, 875 easily, I would have went 4 divided by 2 is 438. Okay, so I have a discrepancy here. So why did I get 2625? All right, because it should be 438. All right, so let me go back and do the math the other way. All right, so if I take 6 over 12, so 1250 times 0.07 times 6 is 5250. And I divide that by 12. Okay, so I must have just used the calculator wrong and end up with 438. All right. So I mean, you see, I made an error by doing the math the longer way, but by not thinking. As you saw when I did this, I punched in the calculator the incorrect numbers and I came up with the wrong number. Well, you know, if I'm doing the mental shortcuts and I'm thinking, it makes the math easier and also makes it easier to know when you're making a mistake and when you don't. This is just skill development that you do from, you know, that you get from experience and constantly thinking about what you're doing, right? But anyway, so we're looking at 438 for the interest, and we're going to credit our note receivable, right? Because we have to offset that for the 12,500, and we debit our cash for the $12,938. Okay. All right. So that's how much cash London is going to give us for the note. Right. So that's it for this this problem. And if you didn't understand something, you know, go back, you know, pause, rewind the video, watch it again. Definitely go back and watch the theory videos if you need a refresher on the idea of using interest receivable versus an accounts receivable. Go back and watch the theory videos about making a closing entry and how they're made instead of just going directly to retained earnings, which the textbook has a tendency to do that. But in the real world, you generally put it to income summary or your expense and revenue summary account in order to create a more easily followed paper trail. The only other thing about this is right here, which I didn't explain. When it's paid off, okay, you can make the one entry for the interest revenue, and that's great when you're making the entry in the middle of the month. But if you end up at the end of the month, at the end of the accounting period, sometimes it's easier because theoretically you should be making an adjusting entry each and every accounting period, right? This was dated 3/5, okay, and that note was created back on, you know, December 6th, right? You know, it all depends upon when you're doing your books. If you're doing your books during, you know, only once a year, you know, so you have a yearly accounting period, but why would you, you know, which they're making their closing entries on December 31st. So if they're only doing their books at the end of the year, okay, an entry like this, get my pen here, come on, pen, yeah. An entry like this is how you would treat the interest revenue. However, if you have like a monthly accounting period, each and every accounting period you would accrue your interest revenue. So when there would have been an accrual for January and accrual for February. And when they go to pay it off in March, okay, you would obviously it wouldn't be $87 because you accrued, you know, only 5 days worth. And you might have a tendency to make the accrual entry as if you were making an adjusting entry, okay? And then just showing the payment for the interest receivable, because when you made the accrual, you credit interest receivable and debit interest, credit interest revenue and debit interest receivable. So you would only have these 3 line items as part of your final entry for the payment of the maturity value. Again, go back and watch the theory videos. That's covered again. And I'm not going to keep on going through it. I just want you to be aware that as you did this work, these are just some areas that need a, to keep a more fully understanding of the concepts while you're doing the work. Go back and watch those theory videos as a refresher to what you need to know. Okay. So with that said, if you don't understand something, go ahead and watch the theory videos, and if you still don't get it, feel free to contact an instructor.